Hey everybody, welcome back for another dividend investing video. As a dividend investor, one of my favorite types of stocks to invest in are real estate investment trusts, or REITs. These provide us with an easy way to add exposure to real estate without the hassle of being a landlord. REITs typically pay hefty dividends, and today I want to highlight 4 REITs that are looking like quite a bargain in the current market. I am Nick. This is the Dividend Growth Income channel. Thank you for joining me today. I'm not a financial advisor, just a guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could do us a favor, please smash that like button and subscribe to keep up with future videos. This helps us out more than you could imagine in bringing you quality dividend investing content. In my opinion, REITs are looking compelling at this moment in time at the end of 2022. The sector has been hit particularly hard. Here is a quick look at VNQ, the Real Estate ETF by Vanguard. This is a market cap weighted ETF of the real estate sector, and note that it is down 25% year to date. And I believe there are some real estate companies that are particularly cheap. So let's go over the criteria I'm used to select these REITs. First, I want the price to AFFO to be lower than its 5-year average. Remember, REITs use price to adjusted funds from operations instead of price to earnings. Second, I want the dividend yield to be greater than its 5-year average. I want a Simply Safe Dividends safety score of 60 or better. And I want a dividend growth track record of 7 or more years. I don't chase yield, and it's not even close to the first thing we should be looking at when we're investing in REITs or any dividend stock. I'm more concerned with things like dividend safety so that we can sleep well at night. And of course, all investments carry some level of risk. I am more concerned with dividend growth as well. I want the income I'm collecting from my investments to grow year over year. And dividend growth is one of the biggest drivers in getting your snowball rolling, along with reinvesting your dividends and making consistent contribution. Anyway, let's get to it. 4 high-quality REITs that are looking cheap. And stick around till the end. I'll cover 2 additional REITs I think deserve an honorable mention that meet the same criteria, and a spot on your dividend and REIT watch list. REIT number 1, Alexandria Real Estate, ticker ARE. Alexandria Real Estate is an urban office real estate investment trust. At a $23.8 billion market cap, ARE is listed as a component of the S&P 500 index. Office REITs normally would not come onto my radar a whole lot, as the trend that we are seeing more and more is becoming a work-from-home society. But this is not your ordinary office REIT. They focus primarily on things that we can't do sitting at our home on our PCs and our underwear. Their properties are primarily healthcare and technology-based tenants in life sciences and biotech industries. Their top tenants are mega-cap healthcare giants such as Eli Lilly, Pfizer, Moderna, and Bristol Myers Squibb. The latter, BMY, is their largest tenant, but still only makes up less than 4% of their revenue. Their properties are strategically placed in urban areas near prestigious universities in places such as Boston and San Francisco to attract tenants. Shares of ARE are down over 33% in the year 2022, and this looks like a bit of an overreaction because this looks like a solid business with a safe dividend. ARE is trading at a forward price to adjusted funds from operations of 21. This is a near 18% discount to its 5-year average price to AFFO of 25.6. That meets our first criteria. Shares of ARE are trading at a dividend yield of 3.29%, which is 23% above its 5-year average dividend yield of 2.69%. That meets our second criteria. Alexandria's dividend makes up 69% of forward adjusted funds from operations. That looks good, with a Simply Safe dividend safety score of 76. That checks off our third criteria. ARE is developing a nice track record of dividend growth with 11 years of increases, and that checks off our final criteria. The dividend was cut in the last recession. That's something to keep in mind. But the average annual dividend growth rate over the last 5 years is 7%. ARE has been announcing dividend raises twice a year, which is a nice perk. The dividend is paid out quarterly in the months of January, April, July, and October at $1.21 per share for a total annual payout of $4.84. Now, if you want that upcoming dividend payment on January 13th, 2023, you'll have to have your shares before December 29th, 2022. Revenue growth has been impressive over the last decade. In 2012, ARE brought in $570 million in sales, and in 2022, they've brought in $2.5 billion in sales. Healthy but sustainable revenue growth is key to being able to grow your dividend year over year in a safe manner. The stock is covered by 11 Wall Street analysts who give it a strong buy rating of 4.54, with 7 rating the stock a strong buy, 3 a buy, and 1 a hold. The average analyst price target is $173.73, representing over 18% upside from current prices. For myself, I'm highly considering opening position here, as I do not have any exposure to this type of real estate across any of my portfolios. This looks like a great time to get into this one. I do get that many folks would like to see a little more yield from their REIT investments than you're getting from Alexandria, but the dividend is growing at a faster rate than your average REIT and is among the safest looking dividends in the office REIT space. Fun side fact, the company is named after Alexandria, Egypt, due to that city's connection to science. REIT number 2, American Tower Corporation, ticker AMT. American Tower is an American real estate investment trust and an owner and operator of wireless and broadband communications infrastructure in several countries worldwide. They were formed in 1995, are headquartered in Boston, and are also a component of the S&P 500 index with its $98 billion market cap. Here's an interesting diagram from their investor relations presentations. How this works is AMT owns the land as well as the base tower structure from which it operates. And this provides the capacity to lease a single tower to multiple tenants. The antenna equipment as well as shelters on the ground are operated by the tenants. This is a global business with 223,000 plus communication sites scattered all across the globe. Adding additional tenants to a property is a wonderful way for them to bring in additional revenue at very little additional cost. This is a cash cow, guys. Shares of AMT are down over 26% in 2022, creating what I believe to be an intriguing entry point for this quality REIT. Let's make sure that checks our 4 criteria. The forward price to adjusted funds from operations is at 20.5, while the historical norm over the last 5 years is 25.4. This is nearly a 20% discount from its average. Criteria 1, check. The dividend yield is nearly 3%, and this is the starting yield has never been available for AMT until just recently. The dividend yield is 50% above its 5-year average of 2%. Criteria 2, check. AMT's dividend takes up 61% of forward AFFO. No concern here. Simply Safe Dividends gives us a safety score of 78. Criteria 3 is met. And our final criteria, a dividend growth streak above 7 years, is met here with 9 years of consecutive dividend raises. At nearly 20% average annual growth rate, this is one of the fastest growing dividends in the real estate sector, and you're getting a strong starting yield of 3%. And as you can see from the payout schedule, AMT announces a dividend raise every quarter. Payments are made every February, April, July, and October in the amount of $156 quarterly for an annual payout of $6.24 per share. Revenue growth has been off the charts, from $2.8 billion in revenues in 2012 to $10.5 billion in 2022. Now here's a breakdown of AMT's tenants, with the big three, AT&T, Verizon, and T-Mobile taking up the majority of US and Canada revenues and a substantial amount of tenant revenue from international. So AMT is covered by 21 Wall Street analysts who give it an overall rating of 4.2 out of 5, rating it a buy, 10 rated a strong buy, 6 a buy, and 5 a hold. The average price target is $251, representing a little more than 19% upside from current levels. Long term, this looks like a great time to be in the tower space, with mobile data traffic expected to grow at a 20% CAGR through 2027. This is one that is high on my radar for 2023, though I don't own it just yet. Let's move on to the next stock. But first, let me just quickly point out that only 27% of you guys watching this are subscribed. Guys, if you made it this far, you definitely like this kind of stuff, so help a brother out and subscribe already. REIT number 3, Digital Realty Trust, ticker DLR. Digital Realty Trust is a real estate investment trust that invests in carrier-neutral data centers and provides co-location and peering services. Founded in 2004 and headquartered in Austin, Digital Realty is part of the S&P 500 index at a $28.4 billion market cap. This is a global business with 304 facilities in over 50 metro areas across 23 countries on 6 continents. Their top customers include IBM, Meta, Comcast, Verizon, AT&T, and Oracle, among many others. DLR has taken a serious beating in the year 2022, down over 42%. Let's check against our 4 criteria. The price to adjusted funds from operations is at a level we've not seen in over 5 years at 15.6. This is a 24% discount to its 5-year average of 20.5, so that checks off criteria number 1. Shares of DLR are yielding 4.86% at the time of publishing, and this is 41% above the 5-year average yield of 3.45%, so that checks off our second criteria. In fact, DLR at a starting yield above 4 hasn't really happened until 2022. As for the safety of DLR's dividend, the payout takes up about 76% of adjusted FFO, and we are happy as long as this is below 90. Simply Safe Dividends gives us a safety score of 94, so they see this as the safest dividend out of the 4 stocks we're talking about here. Criteria 3, check. And last but not least, we have 17 years of dividend growth, which easily checks our 4th criteria. The dividend has been growing at an annual average growth rate of 6% per year. I'll take that for a stock yielding near 5%, right? DLR is a company committed to raising its dividend. The dividend paid out quarterly in the months of January, March, June, and September in the amount of $1.22 for a total annual payout of $4.88. Dividend raises are driven by healthy revenue growth, and in the last year, DLR brought in $4.51 billion in revenue. Compare this to the $1.29 billion they did 10 years prior. DLR is covered by 24 Wall Street analysts, 10 rated as a strong buy, 5 a buy, 8 a hold, and 1 a sell, for a total rating of 4 out of 5, a buy. The average price target for Digital Realty is $125.57. This represents 25% upside from current levels. Shares of DLR are looking to be at a significant discount, and this is a quality business that appears to be doing everything right. I think at the very least, DLR deserves a spot on your watch list for further due diligence. Let's get to the last stock of our group. REIT number 4, Extra Space Storage, ticker EXR. Extra Space Storage is a real estate investment trust that invests in self-storage units. The Utah-based company owns nearly 2,100 locations in 41 states, making them the second largest owner of self-storage units in the U.S. and the largest self-storage property manager. Like the other 3 on this list, this is a large cap REIT and a component of the S&P 500 index. EXR has been a wonderful investment over the last 10 years, with returns outpacing the likes of Google and Home Depot. In 2022, shares of Extra Space Storage are down almost 33%. Let's check out our 4 criteria for EXR. Shares of EXR are trading at a price to AFFO of 17.1, and this is 23% lower than its 5-year average of 22.4. Criteria number 1, check. The dividend yield for Extra Space Storage is currently just above 4%, and this is 22% above the 5-year average of 3.35%. Criteria 2 is met. Now, the dividend makes up 70% of forward AFFO, and Simply Safe Dividends gives us a safety score of 66, so we are good on criteria number 3. Lastly, with 12 years of dividend growth, Extra Space Storage meets all 4 of our criteria for an investment. This dividend is growing at an amazingly fast rate, with the latest raise coming in at 20%. The next raise should be announced soon in February of 2023. EXR pays out its dividend quarterly in the months of March, June, September, and December in the amount of $1.50 per share for a total annual payout of $6. Like other candidates, EXR has seen steady revenue growth over the last decade with no signs of slowing down. Sales were at nearly $2 billion in 2022, while they were at less than $500 million in 2012. We could have made our 5th criteria for all these stocks that Wall Street analysts rated as a buy, as this one also has a buy rating like the other 3, with 14 analysts covering 6 rated a strong buy, 6 rated a hold, 2 a strong sell, for an overall buy rating of 3.57. The average analyst price target is $178.21, representing more than 21% upside from current levels. I think self-storage is a wonderful business model for the next decade. While I don't own EXR yet myself, I do own its competitor CubeSmart, ticker CUBE, which profiles quite similarly but is a mid-cap company. Now, if I wanted to diversify my self-storage investments, I think this would be a great choice, and it's right at its 52-week low. With that said, it's impossible to say whether or not we are at a market bottom here, so that's why I like to use a dollar cost average strategy. And that's Extra Space Storage. I think this is a solid list of REITs that meet our several criteria for dividend growth investors, and they're all sitting at what I believe to be a significant discount. Please do further due diligence in determining if an investment in any of these REITs are right for you, and be sure you understand the tax implications of non-qualified dividends. I like putting these in my Roth IRA, for example. Now, we will feature another list of REITs very soon, our top REITs to own in 2023, so be sure you are subscribed to stay in the loop. We are going through all the sectors in the market to identify the stocks I think dividend growth investors ought to be focused on for 2023 and beyond. As promised, I have 2 additional companies that I think are very intriguing at this level. I consider these to be high-quality companies, maybe slightly more risky than the other 4 I've just highlighted, but they do meet our criteria. Bonus number 1 is Medical Properties Trust, ticker MPW. MPW is a hospital REIT and has taken a dramatic drop over 2022, down nearly 55%. The drop has brought yields up past the 10% mark, but Simply Safe Dividends still rates it at a 70, suggesting a dividend cut is unlikely. That's not to say you aren't taking on risk here, and I generally find that the higher the yield is, the higher risk one is taking. But I do own a small position in this one myself. I do believe in the long-term outlook despite current headwinds. This one met all the criteria earlier for the other stocks, is trading at a price to AFFO of 7.7 with 9 years of dividend growth. Bonus number 2 is East Group Properties, ticker EGP. EGP is an industrial REIT with a focused development in the Sun Belt markets. These are some of the fastest growing markets, and they have a few distribution centers here in my hometown. Now, we have a 3.36% yield with 10 years of dividend growth and actually 27 years of no dividend cuts. The dividend was maintained during the last recession, which is more than most of the REITs on this list can say, unfortunately. Now, this meets the criteria. It's a bit of a smaller company as a component of both the S&P Mid-Cap 400 and the Russell 1000 indexes. Take a closer look at East Group Properties. I think there is a lot to like there, and it's a pretty compelling place. Thanks for sticking around, folks. If you have enjoyed, please give me a like and subscribe. Also, check me out on Twitter at DivGrowthIncome and follow me there. I love connecting with you folks and talking all things investing. Until next time, folks, keep investing.